Hello, it's Mike Natalizio from HNI. I am sitting with Cathy Durham, and we recently had an HNI University event. And our goal at HNI University is to drive change through education. And Cathy came in and she did just that. She gave us a great education on business valuation and succession planning. And I'm with Cathy right now. We're going to kind of give you an overview of what we went through at that session. So Cathy, you're with Capital Valuation Group. Are you ready?
I'm ready.
All right, let's go.
All right, so do you consider yourself a candidate for succession planning? I would hope that if you own a business, you are thinking about succession planning. It does matter. As many business owners are often asking me, what are the things that I need to think about? What is succession planning, first of all? But more importantly, what do I have to understand about my own company and what the value of it might be? So what we think about many times is the fact that there is a clock ticking for all of us who are business owners. And so time remaining means we need to be thinking about what are our options for our business. Doing nothing is just that, doing nothing, and that's not going to get you very far. If something happens to you tomorrow that prevents you from being the leader of your business, that could leave you and or your estate in a bad situation. So doing nothing doesn't make sense. Selling now depends upon if you're interested in selling it. It seems like the people who came to the class were not interested in selling their business, and so that really is not something that we spend very much time looking at. Really, it is, how do I get it ready? How do I get ready to sell my business? And whether you're 35 or 65, you should be preparing for that. So here are a few ideas of things that we sometimes bring up to business owners. They may fit your business and they may not, but usually they're tied to such things as building management depth, looking at areas that aren't running so well and trying to smooth those out, getting processes documented. But that give up control, that's a big one for entrepreneurs. I don't think we like to give up control, and it's very important that we not only give up equity or legal control of our business, but also delegate and give up day-to-day operating control of the business. So you're trying to figure out how to go about doing your exit planning. It certainly takes a diversified group of people, and so these are some of the people that you may need to have on your team. And don't ignore that final one there, the business psychologist. They can be very helpful in assisting you with determining, are you really ready to sell your business? Are you ready to be doing something different? And if so, what does different look like and feel like? So why don't we spend more time? If indeed our businesses are likely the most valuable asset that we own, why don't we spend time working on succession planning? And I believe, as I've thought about it, I think it's just because our plates are full. We are busy managing our business day to day, and when we do think about business valuation or what can I sell my business for, we have people telling us at cocktail parties that they sold theirs for 15 times revenues or 4 times EBIT or EBITDA or whatever acronyms of the day. So I think it's just an overwhelming topic for us to sit and think about. But is it ever important for us to think about it? Because in the next 10 years, in part because of the aging baby boomers, 65% of all closely held businesses are going to change hands. And yet business owners do not know what their business is worth, and 85% of them really have no exit plan, even though we will all exit our businesses at some point.
That's a staggering number. That must mean only 15% have a plan.
That's exactly. You're very smart, Mike. So are you a candidate for succession planning? I certainly hope that you think about that. So what is important when we think about business valuation? Before you even get started on what's the value of your business, I think you need to first ask yourself, do I even have a transferable entity in the first place? So there are two key questions that you can ask yourself. You have a transferable business if the business is not dependent on one person, usually the business owner's skills or relationships. So if you can't come to work tomorrow, can the business continue? And then second question would be, does the business generate enough cash that you could actually pay yourself market compensation? Many times business owners underpay or overpay themselves. What would you be paid if you were to go work for a competitor? And does the business generate sufficient cash flows to pay you market compensation and still have some money left for a return on investment? If the answer to those questions are yes, then you do have a transferable business. And then the next thing we need to think about is, what does value mean? Many times we think about fair market value like it's one clear definition, and yet it's not. And it's not because we've got to characterize who's the buyer and who are the sellers, because different buyers and different sellers will agree on a different value for the business. Then there's strategic value, which is if you can sell your business to a specific, you know who the individual buyer is going to be, the value to that buyer because of synergies or other benefits they could realize might be very different than fair market value. And so when I was saying you need to characterize the buyer, who would the buyer of your business be? This chart is a very useful chart for you to think about in your own business, in your own industry. Who fills these different classifications? At the bottom, we've got your passive investor, job seeker investor. That's somebody like me coming in to buy your business because I think it's a good investment. As we move up the chart in the middle there, we have more of your inside employees and managers, or an employee stock ownership plan buying the business. They work in the business, they have less risk because of that, they'll be willing to pay a higher price. But if you really want to get top dollar for your business, look at 7, 8, and 9 on this chart. Who are your competitors? Better yet, who is a diversifying business that might add what you do to what they do to grow vertically? And then number 9 is really watching your industry and figuring out when is consolidation happening, because the strategically positioned buyer is the buyer who you'd love to find, but you only get a window of opportunity of when consolidation is happening in order to get that buyer. So we could go into an awful lot of detail, and we did that day, about how do you value a business. Well, we value it just like you would see when you value a home. A real estate appraiser uses the asset approach, the market approach, and the income approach. The real estate appraiser certainly is going to focus more on comparables in that market approach. Business appraisers focus more on the income approach. And because there's just so much good information in this, we're going to actually have this as a downloadable document that the listeners can print out and read, and then follow up with us if they have any questions.
So a great tool to get started.
It certainly is. And then there's the danger of multiples. I think as I'm out in the business world teaching bankers and attorneys and business owners about valuation, this is the biggest mistake that I come across, and that is that we think we can value a privately owned or closely held business by applying some multiple times revenues or some multiple times an earnings stream. And closely held businesses cannot be valued by a multiple or a rule of thumb. They can be used as a test of reasonableness. They are not how you value a company. So those are the key factors that we need to be thinking about in valuing a company. Now, how can it be that if I were to tell you that the value of your business is $300,000, I could give you a guarantee right then and there that you would not receive $300,000 for your business? You will receive either a higher amount or a lower amount than that. Why is that? Why is it that it doesn't equal, price does not equal value? Well, it really goes to this image that we have of this fulcrum, that if I tell you that the business is worth $300,000, but I'm in no hurry to sell my business, you're going to increase your offer or your price in order to motivate me to decide to sell my business. But if tomorrow I find out that I have to sell my business because I'm burnt out, as we see sometimes is the case, or I'm diagnosed with something that means I can't really work in the business anymore, or I have a limited time to work in the business, then I'm going to be in a hurry to unload that business, and I'm going to accept a lower price for my business.
So not only does the price vary by buyer, it varies over time.
Certainly does. And that fulcrum right there is another reason why we want to be thinking about succession planning. You want to be selling your business at that opportune time. All right, so we know now, or we have a little bit of an understanding of how do we value a company, but can I increase the value of my business? Well, first and foremost, make that business transferable. Just as we had that stop sign before, you cannot sell a business unless it is transferable. So documenting systems, building relationships, keeping and getting and keeping and training good employees, these things really do matter in getting your business ready for sale. What do buyers value? If you're thinking about selling your business, think about what would a buyer want to see in my business. Well, if you're a strategic thinker and a planner in your business, then you've done some of these things that you see here on this chart. Documenting, documenting, documenting. How does your business run day to day? Also, buyers value diversity of customers. Sometimes we get lost in, boy, look how big my revenues are. Here, company A and B may be in the same industry. Company B is sure more attractive because it has higher revenues. But look at the bottom bullet point there. Their one single largest customer represents 22% of their total revenues, whereas company A, that largest customer, only represents 5% of their total revenues. Buying a business, I want diversity. Clean financials. What do we mean by that? Well, just like this ball of bundled up rubber bands, sometimes business owners, closely held business owners, mix their personal expenses and their personal lifestyle in with their business. They kind of think about it as just two different pockets. Setting aside 2 to 3 years of financial information that you are going to separate any personal expenses from your business expenses. You're managing for profitability, not for trying to manage for taxes. And just keeping those things off of the balance sheet that really don't belong there. And finally, tighten your ship up. Updating, cleaning, no different than when you get ready to sell your home. You are really trying to get your business looking good, running well, keeping good people, and improve that gross profit margin. More than reducing expenses, improve your gross profit margin. Final thoughts, whether you start slow or whether you start fast, the key is to start working on your business, not just in your business.
Cathy, thank you. Thank you very much for coming out and talking at our event. And if people want to contact you, what's the best number to reach you at?
Well, it depends upon the day, but most days start with Madison number, and we're happy to talk at no cost just to better understand business valuation.
Well, again,